Ready, Country Club boy? Doesn't he look like he's playing squash in Greenwich, Connecticut right now? Right. That's what you look like.
I got a bunch of dope new golf clothes. You like them a lot.
You wish like a black t-shirt?
I just wish you would take this more seriously, get a little bit dressed up, that's all.
Hey everybody, JC Peretz here, founder of AllStarCharts.com, and welcome back to Pardon the Price Action. As always, I'm joined by Steven Strazza, and we're going to get right into it. Strazza, we talked about casino stocks last week. I know you bought some DraftKings today. How are you trading this?
Yeah, we got to do a follow-up on this, I thought, because I got into DraftKings today. You can see it here. You can see why I'm buying it, right? We talk about this every week. The charts we want to be buying right now all look the same. They're these nice reversal patterns, these nice bases that are completing and telling us that the trend is now higher. DraftKings is now one of them, gapped higher on earnings. Let me talk about some of the characteristics that I like and why I want to be in the stock. Then you can tell me what you think, and I'll give you some levels. Bullish momentum regime. This thing just keeps pinging overbought. That's characteristic all year so far. If you go to the relative chart next, this is DraftKings versus the S&P. You could draft it. I mean, you could draft it. You could chart it against its peer group too, like something like ARK. It's making, pretty much new all-time highs on a relative basis. So I really like the leadership. When I see a reversal pattern like this in the relative trend, it tells me to expect more outperformance in the future. Those are the kinds of names that I want to be in. And then there's also insider activity in this name. As you know, this is an inside scoop name too, DraftKings, right? So the insider buying too on top of it, kind of like a kicker that I really like. What do you think?
Well, so for me, I'm more interested in the risk management. I like the idea, the setup is nice, right? Nice rounding bottom, bearish to bullish reversal, a saucer bottom is what Edwards and McGee back in the day might call it. That's what it looks like to me. From a risk management standpoint, as you can see here, it's sort of retesting that gap up in earnings. So what are we going to call that? We're going to call that 22, 23, 23 is probably a good level. Is that your level, 23?
Yeah, totally. Right. So I love that we got that retest so quickly. If you look at the earnings gap after last quarter's report, there's about a month of corrective action. It's only been a week, right? So we have to be patient. I bought it today. 23 was my entry, right? It's really 22.50 to 23 is that earnings gap. I've used round numbers here, as you guys could see, because I'm not going crazy over a penny. It's just not how I do things. I will add more, hopefully. I bought a half a position. I'll add more, hopefully, on confirmation, which is back above 25. Now, hear me out. I will also add more back towards 21 with a very tight stop, right? But that becomes a lower probability trade if I'm adding my second half on weakness and not strength. I would much rather pay up and add that second half of the position on strength at 25.
Yep, I agree.
It is a big week for consumer stocks as the market's largest retailers are slated to report earnings. What is the price action suggesting about this group right now?
When you see all the strength in consumer discretionary, it really hasn't been this traditional retail that has stood out. It's been more home construction, as we've discussed plenty. It's been, some of the restaurant stocks and things of that nature. It's been other areas within consumer discretionary. Not so much traditional retail. You could see sort of this messy action. Kind of looks like small caps, kind of looks like financials. You're seeing new lows on a relative basis. That's never a good thing. Whether traditional brick and mortar retails or online retail, again, you're just not seeing much. Look at Amazon. We're above 100. I don't hate it, but there's definitely better places to be, in my opinion. Home Depot, pushing down new lows. Target pushing down new lows, while Walmart, on the other hand, is pushing up against new highs. So I'd be looking at Walmart. Shopify's not looking terrible either. And I would add, some of the I guess restaurants are not considered retail. But when you think about consumer discretionary, I like lean in some of those other areas.
Restaurants are consumer, right? It's that same economy theme. For me, two big things stand out. Why does Walmart look different? So Walmart and Target both, I think, tomorrow, right? And I was flipping through the components today, all the retail stocks, and I couldn't believe how, two seemingly competitors look so different technically, right? Because you got Walmart pressing against the upper bounds, Target on the lower bounds. I think Walmart is more of a staple, right? While Target's more of a discretionary goods retailer. So I think you're really seeing that play out in the chart. The other theme is buy the growthy techie retailers, right? Shopify, there's a reason why that base looks the way it does. I think Amazon should look similar eventually, right? It's that big cap tech, big cap growth theme. So I think you want to focus on the ones with nice bases like Shopify.
All right, new highs for tech. The leadership from technology stocks continues to be impressive as the XLK, which is the tech index fund, keeps hitting new 52-week highs. What are the strongest subgroups? What are the industry groups that stand out?
Yeah, I mean, tech is just so impressive, right? Been the clear leader really for over 2 quarters now. Back to new 52-week highs. I don't think any other sectors can say that right now. I think communications will eventually look the same. You look at that communications chart way at the end there. So 2 really nice bases, but it remains a big cap theme, right? You want to lean on the biggest, best names, which is really your Apples, your Microsofts, your NVIDIAs. And when you go down throughout the space, it becomes more and more of a mixed bag. For me, software is the strongest group, but I think semiconductors are the most important group, with other cyclical sectors, whether it's industrials or materials or financials, really struggling right now. I think it's important that we get this base breakout from the semiconductor indexes.
Yeah, I've always believed that you're not going to get a lot of strength in technology without semiconductors participating. They've been leaders. They've consolidated really nicely, I would argue. And the leaders within semiconductors continue to thrive. Since last summer when the stock market bottomed in June, that was when the list of new 52-week lows list peaked. Things have gotten progressively better since. The Nasdaq's up about 21%. The equally weighted Nasdaq 100 is up 17%. So when they tell you it's only 5 stocks, we know for a fact that it's not. Just because the equally weighted S&P 500 is underperforming, it doesn't mean that breadth is weakening. It just means technology is leading. That's really all it means. And that's what we're seeing.
Still up 17%.
Yeah, right. Exactly. All right.
So sticking with tech, Apple's market capitalization is now a massive $2.7 trillion, making it larger than the entire Russell 2000 index. Is this something you care about, or it's just a sexy headline?
I mean, it's funny. It's not, to me, it's funny. Like, it's cool. Like, stock market nerds like you and me, you're like, oh, haha, look, Apple's the size of this whole index over here. But at the end of the day, it doesn't actually matter. Market capitalizations in stocks continue to get bigger. Years ago, we never had $1 trillion companies. Now we have a whole bunch of them, but the small cap market capitalization is never going to get bigger. It's always going to be because they kick out their best players, and their best players, as they grow in market cap, they join mid caps and ultimately large cap indexes. So literally the small cap index is capped while every other stock continues to make new all-time highs, and we're going to have multiple $1 trillion. So yeah, Apple's worth all of the Russell 2000, but I guarantee you, and I don't make a lot of guarantees in this business, I guarantee you there's going to be a whole lot more stocks that are the size of the Russell 2000, and maybe it doesn't happen tomorrow. Maybe it takes a few years, but there's more coming. So what does it mean to me? It means get used to it.
Yeah, I couldn't agree more. We're going to be talking about Microsoft doing the same thing, Google, and all these others. Because like you said, I'm not going to get into it, but it's just math, right? The Russell 2000 is going to lose any of its best players that are adding to its market cap over time. These big tech names really just playing a different game, too. Like, if I could just drop some stats quick. Apple just announced on their earnings call a $90 billion addition to their share buyback program. That's larger than, there's maybe 150 names in the world that are even that big. That's how much stock they're buying back this year. Over the last 10 years, they bought back about $600 billion in stock. That's a Facebook. That's a Berkshire Hathaway. That's a Tesla, right? So, they're really playing a different game than these small cap stocks. And the bigger are going to keep getting bigger, like you said.
Yeah, expect more of them.
Yes.
All right. So the dollar just registered its biggest weekly gain since peaking last fall. What do you see from the Forex markets these days?
It's really this low 100 zone in Dixie. If you go to the second chart here, it shows it well. We got those pivot lows from earlier in the year around 101, the pivot highs around 105, and then we have prior cycle highs coming in around 102, 103, right? So this whole little, range right here, however it resolves, is just going to be huge. So we've been looking under the hood for clues as to, since the dollar is at an inflection point at this level, where is it likely to go? When you look at our trend summary table here, just a lot of green. A lot of green. That's telling you short-term strength from the dollar relative to other currencies around the world. And if you look at some of these breadth numbers, like, let's do one more chart. This is the highest short-term bullish percentage that we've seen in several months. Maybe the dollar, does give another shot back at those pivot highs. That's what I'm looking for confirmation with that 105 level.
Yeah, interesting divergence here. When you look at the rest of the G10 currencies, pointing to that dollar strength underneath the surface, that with the weakness in the Dixie. So that's an interesting divergence. And let's just keep in mind the correlations here. We're looking at a chart with the dollar index and emerging markets, which traditionally, is kind of already. A lot of people already are familiar with the fact that emerging market stocks tend to do well in a weaker dollar environment and vice versa. But I'll take this one step further, and it's really stocks in general have really seen a strong negative correlation, stocks and the US dollar. So if we continue to see that bid that we just started seeing, I think stocks are going to be under pressure in that environment. But there's really no evidence at all that this is anything more than just a few days of bid, or a few weeks of bid in the dollar. The trend continues to be lower until proven otherwise. So it's front and center as far as I'm concerned.
All right. So this is a game that we like to play. It's called word association. I'm going to call out a word or a phrase. You are going to tell me the first thing that comes to mind. This is a little foreshadowing of what we're about to talk about. Head and Shoulders, not talking about the shampoo.
Knees and toes. That's what comes to me. When you have a 2-year-old and twin boys that are 6 months old, and you tell me Head and Shoulders, I say knees and toes, head, shoulders, knees and toes, right? Eyes and ears and mouth and nose, head, shoulders, knees and toes, knees and toes. That's really what it is to me. Traditionally, these head and shoulders patterns tend to be very reversal in nature. A lot of investors hear about this. It's easy to remember because we have shoulders and a head, so it's very reversal. But let's remember that asset prices trend. So by definition, reversal patterns are more rare circumstances. Do they happen? Yes. Can you see them in historic tops and bottoms? Yes. But those are so few and far between that for me, it's mostly when the head and shoulders top is not a head and shoulders top. And it's really just a consolidation within an ongoing uptrend, because that's what it tends to be more often than not. So,
listen, they're the most popular patterns in technical analysis. I don't know why. To me, they're just tops. And I would reiterate what you just said. Listen, they fail a lot. And they tend to make for a failed head and shoulders tends to make for a great continuation pattern. So
the S&P 500 in the summer of 2010, best ever. I remember, a particular journalist was calling out that the head and shoulders top had officially been completed, and now stocks need to drop. Stocks absolutely ripped off those lows like you've never seen before. When you see a journalist, confirming that a technical pattern has now been confirmed, that's probably not the case. You probably want to take the other side, and that's one of the great moments in stock market journalism history, particularly from a contrarian standpoint. Summer 2010 S&Ps, classic.
I've drawn a bunch of fun head and shoulders patterns for you here. We could talk about them now.
All right. So are you ready for our 2-minute drill, Mr. Straza? Short-term tops and cyclicals, commodity stocks and cyclical groups remain under pressure. How bad is the technical damage, and what are the implications?
It's not just energy that's weak anymore, right? We've totally seen that weakness now spread to materials, and you could even argue, financials, certainly, some groups definitely more than others. I didn't even bring banks charts along, trying to leave them out of it. But you've seen the weakness spread to all these cyclical value groups. Brought along some examples here. Capital markets, right? First one, top hasn't quite gone yet. And again, these are more tactical patterns, right? I'm zooming in on these charts, and these head and shoulders reversal patterns are forming off of the October lows, right? Off the lows from last year. We're getting really toppy here. A lot of sideways 200-day moving averages. You don't want to see this list of completed tops start to grow. For now, we do have a couple like XME and XES. Now, whether the components like Freeport will follow, or whether industrials will follow, or something like aerospace and defense, we'll have to wait and see. But, the bulls really don't see more and more of these tops start completing.
This is a good thing to think about, because over the years, something I've learned is that, these topping patterns, these distribution patterns tend to come after prolonged periods of gains. To be a reversal pattern, there needs to be something to reverse, right? And I'm just not seeing that much of an appreciation going into this potentially distributive behavior in the market, which leads me to believe that it's probably more of a consolidation after that initial thrust off the lows in a lot of these areas. I'll let the market prove that wrong, but if this was massive distribution, if this was a massive bullish to bearish reversal, there would need to be something to reverse, and we simply don't have that. So that's why it leads me to believe that, this is probably a consolidation with perhaps an ongoing uptrend. So I'm very curious to see how this resolves. Again, a lot of this is on the cyclicals, like we've just discussed here, not so much in the growthy areas. A lot of these more growthy areas have gone through, like we discussed, these bearish to bullish reversals. So this is an interesting situation. Let's see if the buyers come in. Every time we're down here in all of these so far over the last 6 or 7 months or so, the buyers have come in. So let's see if they keep stepping up.
If you go to the XME chart, just to build on that, like basically what you're saying is we're not coming off a huge uptrend, right? That we could have some massive top here. So to be very clear, if these tactical patterns do complete, the targets, the objectives are just the October lows, right? So even for something like metals and mining, maybe 12% downside is not like the end of the world, but that would be the level. That would be the next line of support in these.
Hot takes. What do you got this week?
You asked about me yesterday. I got a lot of questions this time of the quarter about this. It's 13F season, right? So we are finding out what our favorite institutions and favorite money managers and investors were buying and selling during the last quarter. So that's what I just want to be really clear about. These reports, and we look through insider filings on a daily basis. We're happy to talk about the 13Fs. They're just far less timely than the Form 4s and the congressional filings and the things that we're used to looking at. Even the Ds and the Gs will give you much more actionable, much more timely information. So be careful. You're going to see a lot of headlines in the coming days and weeks about who bought what. You don't want to pay attention to Steve Cohen or Paul Tudor Jones and what they're doing, because whatever they traded last quarter, they're out of, and they've moved on, right? So we only have a select group of investors that we want to pay much attention to for 13Fs. That's your Buffett, your Icahn, your Ackman, your Einhorn. It's really the long-term value managers, which I don't know if you've noticed, but that list just continues to shrink. It's been such a hard time for these value hedge fund managers. We don't have many that we really look to and say and get excited for 13Fs anymore.
ETJ thinks that the Fed's done and stocks close much higher this year. Whatever that means to you. I don't know about what the Fed's going to do, but stocks closing higher, I agree with. All right, shout out PTJ, one of my faves. And my hot take is that nobody cares what you think. Nobody cares. The market doesn't care what you think. Well, you too, by the way, and me for that matter. Just in generally speaking, when market participants come up with a conclusion on the market based on their fundamentals or their interpretation of the fundamentals, let's just remember the market does not care about your interpretation of the fundamentals. The only thing that pays anyone, myself, Straza, everybody out there listening, is the market's interpretation of those fundamentals. And that's the only interpretation that actually matters. And that's expressed with the prices of assets. And that's what we focus on. Asset prices trend. We know that. So just because the market doesn't care about the things that you think it should care about, doesn't mean the market's wrong, or that the market's crazy, or that nothing matters anymore. Did you ever think that maybe it's that you're wrong?
I'm hearing echoes of our guest on tomorrow's show. Are you channeling some Brian Shannon?
Well, always. Brian Shannon has always been a mentor and, somebody I've always looked up to for many, 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 many years, has had a huge influence on the way I approach markets, most definitely going back almost 17, 18 years. Brian Shannon's been influencing me. So yes, I wasn't thinking about Brian Shannon when I said that, but now that you mention it, yes, as Brian Shannon always says, only price pays. That's it. And price is literally the equilibrium between supply and demand. And it just so happens that the best way to visualize the changes in equilibrium between supply and demand just so happens to be in chart form. That's why we look at so many charts. The reason we do that is because asset prices trend. That's why technical analysis works, because what are we doing? We're looking for trends, right? So nobody cares what you think, only what the market thinks. That's my hot take.
I like it. Trendy stuff.
All right. So everybody, thank you for watching. Make sure to give us a like and hit the subscribe button so that you never miss an update, and follow me at All Star Charts on Twitter, and make sure to follow Steve at S Straza. Leave a comment below and let us know what you think, and we will see you next week.